Do you dream of starting your own business or growing an existing one? One of the most crucial aspects of achieving your goals is managing your funding and finances effectively. In our course on funding and finance management, you will learn how to navigate the complex world of funding, from identifying your funding needs to choosing the right source of financing. We'll also cover the principles of finance management, including how to control expenses, manage cash flow, and make strategic financial decisions that support the long-term success of your business. Our course will guide you through the essential components of finance management, including budgeting, tax planning, and compliance. We'll also discuss the importance of working with experienced financial professionals to help you achieve your business goals. By the end of this course, you'll have a solid foundation in funding and finance management, empowering you to make informed decisions that will help you build a thriving business. Whether you're just starting out or looking to take your business to the next level, this course is for you. Number 1. Funding refers to the money that is provided to a business or organization to support its operations, while finance management involves managing the financial resources of a business or organization to achieve its goals. In today's fast-paced and competitive business environment, securing funding is crucial for the success of any business or organization. From startups to established enterprises, having access to sufficient funding is vital to support operations, invest in growth opportunities, and achieve business goals. But funding alone is not enough. Effective finance management is also essential to ensure that the financial resources of a business are used wisely and strategically. Funding refers to the money that is provided to a business or organization to support its operations. This can come from a variety of sources, such as banks, investors, or government programs. Without funding, businesses may struggle to pay for essential expenses, such as salaries, rent, and supplies, which can hinder growth and even lead to failure. However, having access to funding is not enough. Effective finance management involves managing the financial resources of a business or organization to achieve its goals. This includes developing a financial strategy, monitoring and controlling expenses, managing cash flow, and making strategic financial decisions that support long-term success. Finance management is critical because it ensures that the financial resources of a business are used in the most effective way possible. By monitoring and controlling expenses, businesses can reduce waste and inefficiency, which can help them operate more efficiently and increase profitability. Additionally, effective finance management can help businesses make strategic investments in growth opportunities, such as new products, services, or markets. In conclusion, funding and finance management are both essential components of business success. While funding provides the necessary resources to support operations, effective finance management is essential to ensure that these resources are used strategically and efficiently. By understanding the importance of both funding and finance management, businesses can set themselves up for success and achieve their goals. Number 2, there are several sources of funding, including debt financing and equity financing. Starting or growing a business requires funding, and there are several sources of funding available to entrepreneurs. Debt financing and equity financing are two common types of funding that businesses can consider to raise capital. Debt financing involves borrowing money from a lender, such as a bank or a financial institution. The borrowed funds are paid back over a set period of time, with interest. The advantage of debt financing is that the borrower retains ownership and control of the business. However, the disadvantage is that interest payments can add up over time, and defaulting on a loan can have serious consequences. Equity financing, on the other hand, involves raising capital by selling shares in the business to investors. This can be done through public offerings or private placements. The advantage of equity financing is that there is no obligation to repay the funds, and investors can bring valuable expertise and connections to the business. However, the disadvantage is that investors may want a say in the management of the business, and giving up ownership can be a difficult decision for some entrepreneurs. There are other types of funding available as well, such as grants, crowdfunding, and angel investors. Each type of funding has its own advantages and disadvantages, and it's important for entrepreneurs to consider their options carefully before making a decision. In conclusion, raising capital is a critical step in starting or growing a business, and there are several sources of funding available. Debt financing and equity financing are two common types of funding that businesses can consider. By understanding the advantages and disadvantages of each type of funding, entrepreneurs can make informed decisions and secure the funding they need to achieve their goals. Number 3. It's important to have a clear understanding of your funding needs, as well as the risks and costs associated with different types of funding. Securing funding for your business can be a daunting task, but having a clear understanding of your funding needs is the first step toward success. It's important to identify the amount of funding required, the purpose of the funding, and the timeline for repayment or return on investment. In addition to understanding your funding needs, it's also essential to consider the risks and costs associated with different types of funding. For example, debt financing can be attractive because it allows you to retain ownership and control of your business. However, it also comes with the risk of defaulting on the loan and the associated penalties. Equity financing, on the other hand, can provide valuable resources and expertise to your business, but it also means giving up a portion of ownership and control. It's important to carefully weigh the pros and cons of each type of funding and determine which option is best suited for your business needs. It's also essential to consider the costs associated with different types of funding, such as interest rates, fees, and equity dilution. These costs can significantly impact your bottom line and should be carefully evaluated before making a decision. Finally, it's crucial to have a well-thought-out business plan that outlines your funding needs and how the funds will be used to achieve your goals. This will not only help you secure funding but also ensure that you have a clear roadmap for success. In conclusion, having a clear understanding of your funding needs, as well as the risks and costs associated with different types of funding, is essential for business success. By carefully evaluating your options and creating a well-thought-out business plan, you can secure the funding you need to achieve your goals and take your business to the next level. Number 4. When seeking funding, it's important to have a well-written business plan that outlines your goals, strategies, and financial projections. Starting a business or seeking funding for an existing business requires more than just a great idea. It requires a solid business plan that outlines your goals, strategies, and financial projections. A well-written business plan is an essential tool when seeking funding, as it provides potential investors or lenders with a clear understanding of your business and its potential for success. A business plan should include a detailed description of your business, including its mission, products or services, and target market. It should also include information about your industry and competitors, as well as your marketing and sales strategies. Financial projections are a crucial part of any business plan, as they provide investors or lenders with an understanding of your expected revenue, expenses, and profitability. These projections should include cash flow statements, balance sheets, and income statements. A solid business plan can also help you identify potential challenges and risks, as well as strategies for mitigating those risks. This can help you make more informed decisions and increase the likelihood of success. In addition to being an essential tool when seeking funding, a business plan can also be useful for internal purposes. It can serve as a roadmap for your business, helping you stay focused on your goals and strategies. In conclusion, having a well-written business plan is crucial when seeking funding for your business. It provides potential investors or lenders with a clear understanding of your business and its potential for success. It can also serve as a roadmap for your business, helping you stay focused on your goals and strategies. By taking the time to create a solid business plan, you can increase the likelihood of securing funding and achieving long-term success. Number 5. Effective finance management involves monitoring and controlling expenses, managing cash flow, and making strategic financial decisions that support the long-term success of the business. Effective finance management is essential for the long-term success of any business. It involves monitoring and controlling expenses, managing cash flow, and making strategic financial decisions that support the growth and profitability of the business. One of the key aspects of finance management is monitoring and controlling expenses. This includes keeping track of all expenses, identifying areas where costs can be reduced, and implementing strategies to cut unnecessary expenses. By controlling expenses, businesses can improve their profitability and ensure they have the resources they need to grow and expand. Managing cash flow is also crucial for effective finance management. This involves ensuring that the business has enough cash on hand to cover its operating expenses and other financial obligations. By carefully managing cash flow, businesses can avoid cash flow problems that can lead to financial difficulties or even bankruptcy. Another important aspect of finance management is making strategic financial decisions that support the long-term success of the business. This includes decisions related to investments, financing, and risk management. By making informed financial decisions, businesses can improve their profitability and position themselves for long-term success. Effective finance management also involves staying up to date on financial trends and regulations. This includes understanding tax laws, accounting standards, and other financial regulations that may impact the business. By staying informed, businesses can ensure they are in compliance with all relevant regulations and avoid financial penalties or other legal issues. In conclusion, effective finance management is essential for the long-term success of any business. By monitoring and controlling expenses, managing cash flow, and making strategic financial decisions, businesses can improve their profitability, position themselves for growth, and avoid financial difficulties or other legal issues. By staying informed and making informed financial decisions, businesses can achieve long-term success and thrive in a competitive market. Number 6. One of the key principles of finance management is to maintain adequate cash reserves to cover unexpected expenses and avoid cash flow problems. Cash is the lifeblood of any business. It's what keeps the lights on, pays the bills, and allows businesses to invest in growth and development. However, unexpected expenses can quickly drain a business's cash reserves and cause cash flow problems that can lead to financial difficulties or even bankruptcy. This is why maintaining adequate cash reserves is one of the key principles of finance management. Adequate cash reserves are essential for businesses to weather unexpected financial storms, such as a sudden decrease in sales, an unforeseen expense, or a natural disaster. By maintaining adequate cash reserves, businesses can avoid cash flow problems that can prevent them from paying bills or making investments in the future. The amount of cash reserves a business needs will depend on several factors, including its size, industry, and financial stability. However, as a general rule of thumb, businesses should aim to maintain at least 3 to 6 months' worth of operating expenses in cash reserves. Maintaining adequate cash reserves also requires careful cash flow management. This involves keeping track of all income and expenses, identifying areas where costs can be reduced, and making strategic financial decisions that support the long-term success of the business. In conclusion, maintaining adequate cash reserves is one of the key principles of finance management. By ensuring that the business has enough cash on hand to cover unexpected expenses and avoid cash flow problems, businesses can position themselves for long-term success and weather any financial storms that come their way. By practicing careful cash flow management and making informed financial decisions, businesses can improve their financial stability and thrive in a competitive market. Number 7. It's important to regularly review and analyze financial data, including income statements, balance sheets, and cash flow statements, to track the financial health of your business. Regularly reviewing and analyzing financial data is crucial for businesses to track their financial health and make informed financial decisions. Financial data includes income statements, balance sheets, and cash flow statements, which provide insights into the business's financial performance and overall health. Income statements show a business's revenue and expenses over a specific period, such as a month, quarter, or year. By analyzing income statements, businesses can identify trends in revenue and expenses, as well as areas where costs can be reduced. Balance sheets provide a snapshot of a business's financial position at a specific point in time. They show the business's assets, liabilities, and equity. By analyzing balance sheets, businesses can identify areas where they may need to increase their assets or decrease their liabilities to improve their financial position. Cash flow statements show the amount of cash that flows in and out of a business over a specific period. By analyzing cash flow statements, businesses can identify areas where they may need to increase their cash flow or reduce their expenses to improve their financial stability. Regularly reviewing and analyzing financial data allows businesses to make informed financial decisions that support their long-term success. It also helps businesses identify potential financial problems early on, allowing them to take corrective action before the problem becomes more severe. In conclusion, regularly reviewing and analyzing financial data is essential for businesses to track their financial health and make informed financial decisions. By analyzing income statements, balance sheets, and cash flow statements, businesses can identify areas where they need to improve their financial performance and take action to improve their financial stability and position themselves for long-term success. By staying on top of their financial data, businesses can make informed decisions and thrive in a competitive market. Number 8, budgeting is an essential part of finance management, as it helps you plan and control expenses, allocate resources effectively, and achieve your financial goals. Budgeting is a critical part of finance management, and it's essential for businesses of all sizes. Budgeting helps businesses plan and control their expenses, allocate resources effectively, and achieve their financial goals. Budgeting involves creating a financial plan that outlines the business's expected income and expenses over a specific period, such as a month, quarter, or year. By creating a budget, businesses can ensure they have enough funds to cover their expenses and invest in growth opportunities. Effective budgeting also helps businesses identify areas where they can reduce costs and improve their financial performance. For example, a business may identify areas where they can cut unnecessary expenses or negotiate better deals with suppliers to reduce their costs. In addition to helping businesses control expenses, budgeting also allows them to allocate resources effectively. By setting financial goals and creating a budget, businesses can ensure they have the resources they need to achieve those goals. Budgeting also helps businesses plan for the future. By creating a budget and tracking their actual financial performance against that budget, businesses can identify potential problems early on and take corrective action before they become more severe. In conclusion, budgeting is an essential part of finance management. By creating a budget, businesses can plan and control their expenses, allocate resources effectively, and achieve their financial goals. Effective budgeting also helps businesses identify areas where they can reduce costs, improve their financial performance, and plan for the future. With proper budgeting, businesses can make informed financial decisions and thrive in a competitive market. Number 9, tax planning and compliance are also critical components of finance management, as non-compliance with tax regulations can result in significant financial penalties. Tax planning and compliance are critical components of finance management, as they can have a significant impact on a business's financial health. Non-compliance with tax regulations can result in hefty financial penalties, which can negatively affect a business's profitability and reputation. Effective tax planning involves analyzing a business's financial situation and identifying opportunities to minimize tax liability while staying compliant with tax laws and regulations. By managing tax obligations effectively, businesses can reduce their overall tax burden and improve their financial performance. Tax compliance involves ensuring that a business meets all of its tax obligations, such as filing accurate tax returns and paying taxes on time. Compliance with tax regulations is essential to avoid costly penalties and legal issues that can arise from non-compliance. In addition to managing tax obligations, effective tax planning also helps businesses take advantage of tax incentives and credits that can reduce their tax liability. By staying up to date on changes to tax laws and regulations, businesses can take advantage of these opportunities and improve their financial performance. Proper tax planning and compliance also help businesses maintain their reputation and credibility. By meeting all of their tax obligations, businesses can demonstrate their commitment to ethical and responsible financial practices. In conclusion, tax planning and compliance are critical components of finance management. Effective tax planning can help businesses minimize their tax liability, take advantage of tax incentives, and improve their financial performance. Compliance with tax regulations is essential to avoid costly penalties and legal issues that can arise from non-compliance. By prioritizing tax planning and compliance, businesses can protect their financial health and reputation. Number 10, finally, it's important to work with experienced financial professionals, such as accountants and financial advisors, to ensure that your funding and finance management strategies are effective and aligned with your business goals. Running a successful business requires effective funding and finance management strategies. However, navigating the complexities of finance management can be challenging, particularly for small business owners who may lack the necessary expertise and resources. Working with experienced financial professionals, such as accountants and financial advisors, can help business owners develop effective finance management strategies and ensure that they are aligned with their business goals. These professionals can provide valuable insights and guidance on managing finances, tracking performance, and making strategic financial decisions. Accountants can assist with bookkeeping, financial statement preparation, tax planning and compliance, and other financial reporting requirements. They can also help businesses monitor and control expenses, manage cash flow, and identify opportunities to improve financial performance. Financial advisors can help businesses develop long-term financial plans, including investment strategies and retirement planning. They can also provide guidance on managing debt, financing options, and risk management. By working with experienced financial professionals, business owners can benefit from their expertise and insights, freeing up time and resources to focus on growing their business. Additionally, financial professionals can help business owners stay informed of changes in tax laws and regulations, identify financial risks, and develop strategies to mitigate those risks. In conclusion, working with experienced financial professionals is essential for effective funding and finance management. Accountants and financial advisors can provide valuable insights and guidance on managing finances, developing long-term financial plans, and making strategic financial decisions that support the long-term success of the business. By leveraging their expertise, business owners can ensure that their finances are managed effectively, efficiently, and in line with their business goals.